Here's a number that stopped me in my tracks. A recent study looked at what the average Ontario household should have in life insurance versus what they actually have. The gap? More than 30%. Now, in real dollars, the typical Ontario family needs somewhere close to 800,000 in coverage. And really it holds a little over 500,000. Now, that's not a small rounding error. That's the difference between a family keeping the house and a family having to sell it. And here's the part that gets me. It's usually not because people did something wrong. It's because life kept moving. You bought a bit of coverage back when your mortgage was smaller, your income was lower, and the kids, well, they weren't even a rumor yet. The coverage stayed frozen in time, but life didn't. So today, I want to walk you through life insurance the way it actually shows up in a real life, stage by stage. Not, here's a product, buy it. More like, here's what your future self is probably going to need so you're not caught flat footed. Now, grab a coffee and let's get into it. But, quick promise before we start. I'm not going to sell you anything in this video. I'm going to teach you how this works so you can make your own call. Deal? Deal. Now, let's clear the fog first because life insurance sounds more complicated than it is. Strip it right down. You pay a company a small, predictable amount, could be the price of a couple coffees a week, and in return, if you pass away, they hand your family a big, tax-free check. And don't forget that in Canada, that death benefit lands in your beneficiary's hands with no tax on it. That's the whole magic trick. You're trading a small known cost now to erase a giant unknown cost later. Two flavors, and I'll keep it simple here. Term insurance is coverage that lasts for a set stretch, say 20 or 30 years, and then ends. It's cheap because it's temporary. It's built for temporary problems. And here's a secret. Most of your big problems, they are temporary. The mortgage gets paid off. The kids grow up and start funding their own questionable decisions. Now, permanent insurance lasts your whole life and usually costs more. It's built for the things that never expire. Final costs, an estate, a legacy you want to leave behind. Most people, most of the time, need term. Some people, for specific reasons, want permanent. Neither one is better. They're just different tools for different jobs. Now, hang on to that because it comes up at every stage. Okay, stage one. You're in your 20s, single, maybe renting, and nobody depends on your income. Do you need a big life insurance policy? Honestly, probably not a big one. If you passed away tomorrow, nobody's mortgage goes unpaid. No kids lose their lunch, and I'm not going to pretend otherwise just to make a sale. That's not how I operate. But, and it's a real but, there are two quiet reasons this stage matters more than people think. Number one, your health and your age will literally never be better right now than they are. Insurance is priced on those two things. Locking in a modest policy while you're young and healthy can freeze in a low rate for decades. It's a little like buying concert tickets before the artist blows up. Now, two, if you have co-signed debt, if your parents co-signed your student loan or your car and something happened to you, well, that debt can land on them. Now, a small policy quietly protects the people who backed you. So, stage one isn't buy a fortune, it's consider a small, cheap policy mostly to lock in your health. No pressure, no urgency, just a door worth leaving open. Now, let's fast forward. You've met someone. Maybe you've moved in together. Maybe there's a ring. Maybe there's just a shared Netflix account you'd both fight for in the divorce. But here's what changes. Your lives start to financially braid together. A shared apartment, a shared car loan, maybe shared plans. When two people build something together, the loss of one income stops being just sad. It becomes a bill. Now, if you're both working and you don't own a home yet, the need is still fairly modest. If one of you passed, the other could probably carry on. But this is a stage to start the conversation because the next stage sneaks up fast and it's genuinely worth talking about out loud with your partner. Is it morbid? Well, a little, but answering, what would you actually need if I weren't here, is one of the most loving conversations you can have. Do it over pizza. Makes it easier. Now, this next one, this is the big one. You buy a house. The day you sign that mortgage, you take on the single biggest debt of your life. And now there are real stakes. Because if something happens to you, your partner is potentially staring at that entire mortgage on one income. Now, that's the moment a lot of families quietly become underinsured without actually knowing it. Now, when you get your mortgage, the bank will absolutely offer you mortgage insurance right there at the table. And I want to be straight with you about this because it's one of the most misunderstood products in the country. Mortgage insurance from the bank pays the bank. As your mortgage shrinks, so does the coverage, but your premium usually doesn't. And here's a kicker. With a lot of these, the deep health questions get sorted out after you die, at claim time, when your family's the one dealing with it. Now, compare that to your own individual term policy. The coverage amount stays level or the same. It doesn't shrink as you pay down the house. The check goes to your family, not the lender, and they decide how to use it. And you're approved up front. So there's no nasty surprise at the worst possible moment. Now, for most people, individual term is the stronger tool here. Not always, but most of the time. If you take one thing from this whole video, maybe let it be this. Don't just say yes to the form at the bank without knowing there's a better fitting option. And now, the kids show up. Congratulations. You will never sleep or be financially relaxed again. This is the peak. If there's one stage where the coverage gap does the most damage, it's this one. Because now people are depending on your income to eat, stay housed, and grow up. Let me walk through what your family would actually have to replace if you weren't there. Your income for years, not 1 year. The years until those kids are grown up and standing on their own feet. Childcare. This is the one everybody forgets. Now, if a stay-at-home parent passes away, someone has to pay for everything that parent did. The childcare, the driving, the cooking, the running of the household. That's a real measurable cost, and it's why the parent who doesn't earn a paycheck still absolutely needs coverage. Their work has a dollar value, even if it never had a payslip. The mortgage, future education costs, the debts. Here's a reality check on what most families are leaning on. Your group insurance through work is usually 1 or 2 times your salary. And the CPP death benefit, the government one, well, it tops out at $2,500. Yeah, $2,500. So that's a nice gesture and roughly 1 month of daycare. Neither of those is a plan. They're a rounding error against what a young family actually needs. Now, to put a real number on it, picture a 34-year-old parent in Ontario earning $95,000 with a mortgage around $480 and 2 kids. Run the math, and the need comes out to around $1.5 million. Now, most people with that profile are carrying a tenth of that through work and calling it covered. So I'm not telling you this to scare you. I'm telling you this so the number doesn't surprise you. There's a big need, but here's a relief. Because term insurance is cheap, covering a need like that is far more affordable than people expect. This is exactly the stage where little planning buys enormous peace of mind. Next stage. You're in your peak earning years. Career's humming. Income's up. Maybe you've upsized the house. Life's good. The trap here is drift. Your income went up. Your mortgage may have gone up, but your coverage? Well, it's the same policy about a decade ago. It didn't get the memo. This is the review stage. Now, every few years, and every time something big changes, a raise, a move, a new baby, a new business, it's worth asking one simple question. Does my coverage still match my life? Now, most of the time, the answer is, it's a little behind, and that's an easy fix. It's also the stage where some folks, permanent insurance starts to make sense. If you've maxed out your registered accounts, or you're thinking about an estate, or you own a business, that's a real conversation, but it's a personalized one. There's no rule of thumb for it. It depends entirely on your situation, and that's a sit down with an advisor discussion, not a YouTube video one. Now, the kids are grown and, miracle of miracles, financially independent. The mortgage is nearly gone, or gone. So here's the good news nobody tells you. Your life insurance need often shrinks at this stage. The whole point of term was to cover those temporary responsibilities, and a bunch of them just expired in the best way possible. So this isn't a buy more stage for a lot of people. It's a you might need less, and that's a win stage. The focus quietly shifts from protecting an income to thinking about a legacy, which brings us to the last stage. Retirement. The paycheck stops, the plan you built takes over. Life insurance still has a couple of jobs here, and they're very different from before. Final expenses, funerals, and final costs are more than people expect. And a small policy means your family isn't covering that in a hard week. Estate liquidity, and this is the one that surprises many Canadians. We don't have an inheritance tax here, which is great, but there can still be a tax bill when you pass, especially on things like your RSP or RIF, which can be taxed at death unless they roll over to a spouse. If most of your wealth is tied up in the house or the cottage or some investments, your family can get hit with a bill and no cash to pay for it. So they're forced to sell the very thing you wanted to leave them. Now, permanent life insurance can create the tax-free cash to cover that, so the cottage stays in the family. And finally, the fun one, a legacy. Some people simply want to leave a tax-free gift to their kids, grandkids, or a cause that they love. Life insurance is one of the most efficient ways to do exactly that. And I'll flag it plainly. The tax stuff at death is real, but it depends on your specific setup. It's a conversation for you, an advisor, and sometimes your accountant. Now, don't take a number off a video as gospel, including mine. So, how do you actually figure out your number? Well, let me give you two tools I'd use. The quick one, take your income, multiply it by 10 to 15, and there's your rough starting point. Not necessarily the final answer. The better one, and my favorite because it's simple and works, is called DIME. 4 letters. D for debt. Add up your debts, not counting the mortgage. I, income. Your yearly income times the number of years your family would need, generally 10, 15 years. M, mortgage. The full balance so the house is safe. And E, education. Roughly what you'd want set aside for the kids. Now add those 4 up, and that's your ballpark need. Then subtract what you already have. Your group coverage, any existing policy. Whatever's left over, that's your gap. That's the number that actually matters. And knowing your gap is the whole ball game. Remember, you can't fix a problem you can't see. Now, most people have never done this little 2-minute exercise even once. And it's the single most clarifying thing you can do. So, there it is. Life insurance across a whole life. Little to none when young and unattached, ramping up hard through the mortgage and kids' years, and peaking when a family leans on you. Then easing off as responsibilities retire right alongside you. The big takeaway, though, isn't buy more insurance. It's this. Your life keeps changing, So your coverage should get a checkup every few years too. Life doesn't sit still, and neither should your plan. If you're sitting there thinking, I have genuinely no idea what my gap is, well, that's good. That means you're paying attention. So head over to howmuchdoineed.ca and figure out your number. Or if you'd rather just talk it through with an actual human who won't pressure you, I promised at the beginning, you can book a no strings attached chat at bookwithtrevor.ca. Now, whether you end up buying or not, you will walk away smarter than when you got here. That's the only promise I make. Don't overthink it. Don't wait for the time, and just get it started. Now, I'm Trevor, the Guelph Insurance Guy. Now make it a great day, unless you have other plans.